There are moments in markets when the numbers on the screen tell one story, but the behavior behind those numbers tells a completely different one. And right now, many observers are asking a very serious question. If silver is approaching the powerful $89 to $90 level, why are massive short positions suddenly appearing at exactly that point? Is it coincidence or is it something deeper? Because throughout financial history, whenever an asset approaches a psychological threshold, pressure often appears out of nowhere. The question isn't just about silver's price. The real question is about how markets behave when they approach levels that make powerful players uncomfortable. Silver has always been one of the most fascinating metals in the financial world. It sits at a unique intersection between money, industry, and psychology. Unlike many assets that move purely on speculation, silver carries thousands of years of monetary history while also being deeply embedded in modern technology. Solar panels, electronics, advanced medical equipment, these industries quietly rely on silver every single day. So when the price of silver begins climbing toward a level like $89 or $90, people naturally start paying attention. And that's where the conversation about manipulation often begins. But before jumping to conclusions, it's important to understand something about how markets actually work. Financial markets are not simply buyers versus sellers in a straightforward contest. They are complex ecosystems filled with hedgers, institutions, speculators, manufacturers, and algorithmic systems that react to price levels in ways that sometimes look coordinated, even when they may not be. Yet when large clusters of short positions appear at specific price zones, especially near psychological levels, it raises eyebrows across the financial community. Think about a mountain climber approaching the summit. The closer they get to the peak, the more resistance they feel. Stronger winds, thinner air, more obstacles. Markets often behave in a similar way. When an asset climbs toward a major round number like $90, the journey rarely remains smooth. Sellers emerge. Traders attempt to defend positions, institutions adjust risk, and the market becomes a battlefield of expectations. Now here's where things become interesting. Short positions themselves are not inherently negative or suspicious. In fact, short selling plays an important role in healthy markets. It allows participants to hedge risk, provide liquidity, and challenge overconfidence. But when the size of short positions becomes unusually large right at a major breakout level, it creates a tension in the system. That tension can either suppress the price temporarily or eventually create explosive volatility if the pressure becomes too great. Imagine a tightly coiled spring. The more pressure applied to it, the more energy it stores. If the pressure holds, the spring remains compressed. But if the pressure suddenly releases, that stored energy can produce a dramatic movement. Markets often behave in exactly the same way. Large concentrations of shorts near a major price level can act like that compressed spring. And this brings us to a broader lesson that extends far beyond silver itself. Financial markets are not just about numbers, they are about narratives, expectations, and psychology. When investors begin discussing the possibility of manipulation, what they're really reacting to is a sense that the market's visible price may not fully reflect underlying forces. Sometimes that perception is accurate, sometimes it's simply the complexity of global finance revealing itself. Consider how many layers exist in modern markets. Futures exchanges, physical metal supply chains, derivatives, institutional hedging, algorithmic trading systems, and global macroeconomic pressures all interact at the same time. The result can look mysterious from the outside. Price moves rapidly, positions accumulate, volatility appears suddenly, and observers try to piece together the puzzle. But rather than focusing purely on the drama of the moment, there is a powerful mindset shift that long-term observers often adopt. Instead of asking only, who is manipulating what, they begin asking a deeper question. What structural forces might be shaping this market? Because once you begin studying structure, supply, demand, positioning, sentiment, you start to see patterns that repeat throughout financial history. For example, major psychological levels have always acted like magnets in markets. Think of round numbers like $50, $100, $1,000, or $10,000 across different assets. Human psychology naturally anchors around these points. Traders place orders there. Institutions manage risk around them. Algorithms detect momentum shifts around them. So when silver approaches $89 or $90, it's not just a price. It becomes a symbol of potential transition. And transitions in markets are rarely quiet. They're noisy, emotional, and often confusing. That confusion is exactly what creates opportunity for learning. The most successful market observers are rarely the loudest voices predicting dramatic outcomes. Instead, they are the patient analysts studying how pressure builds beneath the surface. Take a moment to think about how information spreads today. Social media, financial forums, real-time charts, millions of people are watching the same levels at the same time. When a price approaches a level like $90, attention itself becomes a force in the market. Traders react faster. News spreads instantly. Sentiment shifts minute by minute. The result is a feedback loop where expectations influence price behavior. But here's the deeper lesson. The market's job is not to reward expectations. Its job is to challenge them. Sometimes the most crowded narrative in finance turns out to be wrong. Other times the narrative is correct, but the timing surprises everyone. This is why disciplined observers focus less on prediction and more on preparation. They study positioning data. They observe how prices react to pressure. They watch how quickly markets recover from declines or fail to recover, because those reactions often reveal more truth than the headlines. For example, if massive short positions appear near a level like $89 or $90, the most interesting question becomes, how does the market respond to that pressure? Does price collapse immediately? Does it stall temporarily and then continue climbing? Or does it move sideways while tension builds? Each of these outcomes tells a different story. If the price falls sharply, it may suggest that sellers truly dominate the market at that level. If the price stabilizes and gradually moves higher despite the shorts, it may indicate underlying strength. And if the market becomes trapped in a narrow range, it can signal that both sides are waiting for a catalyst. Markets often resemble chess more than boxing. Moves are calculated, positions are defended, strategies unfold over time rather than in a single dramatic moment. And the players who survive longest are those who stay calm while everyone else reacts emotionally. Another powerful insight emerges when you zoom out and look at the bigger picture. Silver has historically been one of the most volatile major commodities in the world. It can move dramatically during periods of economic uncertainty, technological change, or shifts in global liquidity. That volatility attracts both believers and skeptics. On one side, some people see silver as an undervalued monetary metal with centuries of history. On the other side, skeptics view it as just another commodity subject to industrial cycles and speculation. The truth, as often happens in markets, likely exists somewhere between these extremes. What makes silver fascinating is that it refuses to stay in a single category. It behaves partly like money, partly like an industrial resource, and partly like a speculative asset. This unique identity means its price movements often reflect multiple forces at once. And when multiple forces collide near a major price level, the market becomes a stage for dramatic tension. So what can viewers and observers actually learn from moments like this? First, it's a reminder that financial literacy matters more than ever. Understanding how futures markets work, how short positions function, and how institutional hedging operates can transform confusion into clarity. The more you learn about market structure, the less mysterious these events become. Second, it highlights the importance of emotional discipline. When headlines scream about manipulation or sudden price moves, it's easy to get pulled into the noise. But the most valuable perspective often comes from stepping back and observing the broader trend. Third, it reinforces a timeless principle. Markets reward patience more than excitement. Dramatic moves may grab attention, but long-term understanding comes from studying cycles, not reacting to every spike or drop. Think of the financial world as an ocean. On the surface, waves crash and swirl unpredictably. But deep below the surface, powerful currents move slowly and steadily. Those deep currents, economic shifts, industrial demand, global liquidity, often shape the long-term direction of markets. When silver approaches a level like $89 or $90 and massive short positions appear, the surface waves become chaotic. Traders argue, analysts debate, social media explodes with theories, but the deeper currents continue moving, and the observers who focus on those deeper currents are the ones who gradually develop real insight. Because in the end, markets are teachers. Every unusual event, every price surge, every unexpected wall of selling becomes part of a larger lesson about human behavior, risk, and resilience. Silver's journey toward major price levels is not just a story about metal. It's a story about how people react to uncertainty, how institutions manage risk, and how psychology influences billions of dollars moving through global markets. Whether the shorts at $89 to $90 hold the line or eventually give way is something only time will reveal. Markets always write the final chapter themselves, but the conversation happening right now is valuable because it encourages people to look deeper, ask better questions, and understand the mechanics behind the headlines. And that understanding is far more powerful than any single price prediction. So if you found this exploration useful, take a moment to reflect on the bigger lesson behind today's discussion. Markets are complex, fascinating systems filled with hidden dynamics and powerful psychology. The more we study them with curiosity and discipline, the more confident and informed we become as observers of the financial world. If this perspective helped you see the silver story from a new angle, consider sharing your thoughts in the comments. Conversations like this help build a community of curious thinkers who value knowledge over noise. And if you enjoy deep dives into the forces shaping global markets, make sure to like the video and subscribe so you don't miss future discussions that explore the hidden mechanics behind the headlines.